Now that you know the theoretical construction of liquidity ratios, let us take a look at set of financial statements and try to analyze the liquidity position of a business. On your screen is profit and loss account of ABC Limited for the year ended on March 31st, 2015, and we also have a balance sheet for the same company. Now we are going to make use of this information and analyze the liquidity position. The first ratio, as we learned to analyze the liquidity position of the business, is current ratio. Current ratio is simply the ratio between current assets and current liabilities. All we have to do now is go to the balance sheet of this company and identify the items which will fall under the categories of current assets and current liabilities. So in the balance sheet, you have debtors, which is current assets. You have stock, you have bills receivable, prepaid expenses, cash in hand, cash at bank. In fact, apart from fixed asset item, which is at the top of the asset side of balance sheet, the rest of the items are current assets. So all these items will fall under the category of current assets. Therefore, the total of current assets will be equal to debtors, stock, bills receivable, prepaid expenses, cash, and bank. Now you need to put the amount of these and calculate the sum for the current assets. Stock is 8,000, bills receivable is 5,000, prepaid expenses 2,500, cash and bank are both 10,000. The total current assets are hence 45,500. Similarly, we will calculate the amount for current liabilities. In the balance sheet, you will notice bills payable, creditors, and outstanding expenses, three items falling under the head of current liabilities. So bills payable, creditors, and outstanding expenses. Bills payables is 2,000, creditors equal to 18,000, and outstanding expenses are 3,000. Total current liabilities that you have is equal to 23,000. All you have to do now is calculate the current ratio, which is going to be 45,500 divided by 23,000, and you get 1.97 as the current ratio. Now this ratio means that the current assets are almost double the current liabilities, and we know the rule of thumb for current ratio is 2:1. That shows a healthy business. Short-term financial position of this particular business is very close to a very healthy business. Let's now go to the second short-term liquidity ratio, which is liquid ratio, which will be calculated by identifying the liquid assets and dividing this by current liabilities. Now liquid assets are simply current assets minus stock and prepaid expenses. And we have discussed the reason for this as well. Stock and prepaid expenses, stock is not really sure to be converted into cash, and prepaid expenses is actually an expense which incurred in advance for future, and there is no more cash coming in from this particular item, although it is a current asset. So these two do not contribute to the cash of the business with real certainty. Therefore, we exclude these two from the current assets to find out the liquid assets. So current assets in the previous slide we saw were equal to 45,500, and we are going to deduct the amount of stock and prepaid expenses, which is equal to 8,000 and 2,500. Now this gives us liquid assets worth 35,000 here. And we know the amount of current liabilities is equal to 23,000 from the previous ratio. Therefore, liquid ratio is equal to 35,000 divided by 23,000. And this comes out to be 1.52. Now, this means even if we take out two uncertain current assets, which are stock and prepaid expenses, the remaining current assets are still 1.52 times the current liabilities. You are still able to cover your current liabilities, and hence your creditors can rest assured. This is a good sign for the business. The thumb rule for this ratio is 1:1, and liquid ratio in this case is exceeding 1:1 by significant magnitude. So the business is positioned very well according to this particular ratio. Let's now look at the absolute liquid ratio, in which we will calculate the ratio between absolute liquid assets and current liabilities again. Absolute liquid assets are equal to cash plus bank plus marketable securities. Now, marketable securities are the securities or investments which can be readily converted into cash. Now, in this case, we do not see any item of marketable securities in the balance sheet. All we have is cash in hand and cash at bank. So we take these two items, sum these up for 2015, and take those as absolute liquid assets. Therefore, the absolute liquid ratio is equal to 20,000 divided by 23,000, and this comes out to be 0.869. Now we know the thumb rule for absolute liquid ratio is 0.5. Your absolute liquid assets should be at least half of the current liabilities. In this case, we are exceeding the thumb rule, and hence we can conclude that the business is doing fine in the short run. However, again, this ratio can vary from industry to industry. In this case, we do not have the information on industry, but when you are analyzing these ratios for an industry, make sure to use the industry standard ratios as the thumb rule for different types of analysis. Now, in this case, 0.869 means that if we were to pay off our current liabilities immediately, only 86% of those current liabilities can be paid off using the immediate cash that we have. For the remaining, those creditors will have to wait for some time before we can convert rest of our current assets into cash.